Running a business in Philadelphia takes a lot. It takes strong relationships, unique insight, and inspired leadership. Running a business in Philadelphia takes a lot. It takes strong relationships, unique insight, and inspired leadership. It takes staying in the know and making the most of every opportunity. Everything it takes is everything you'll find at CCPA. A resource for business support, a chance to hear from experts in their field and get up close and personal with city leaders. An insider's guide to what's happening and what's next in Philadelphia. With CCPA, business is personal.
Good morning, everyone. It's great to see you all here today. Thank you for joining us. I'm Suzette Munley of Munley Associates and the president of CCPA. I hope everyone is doing well and feeling a bit more optimistic about getting back into the city and kicking off a great summer. CCPA is an intimate, diverse group of business owners, executives, and managers looking to build relationships and offer each other meaningful resources. We take pride in bringing you unparalleled access to speakers, decision makers, and leaders who are shaping Center City. We keep our members and guests informed about business challenges and opportunities in Philadelphia. So let's take a minute and touch on the benefits of becoming a member, a sponsor, or collaborating with CCPA. We think it's easiest to remember as being Center City's smart. We have signature events where you get the inside scoop on development, sustainability, exceptional women leaders, and the city's movers and shakers. There are marketing opportunities available only to members and sponsors, enabling you to reach thousands of businesses and consumers. You have access to our speakers and panelists in a way few organizations can deliver. The up-close, intimate, and personal experience of a CCPA event is like no other. You can reimagine employee benefits available to members through Penworth Financial Services. And you can take the lead with opportunities to build your network, grow your business, and be a CCPA ambassador. So if you'd like to join today, there's a link posted in the chat. And to mark your calendars for our upcoming events, they are posted now on your screen, so please take note of those. Special call out to our next Women Changing the City on June 9th, and Lunch with City Leaders with Jeff Hornstein of the Economy League of Greater Philadelphia. For today's event, we encourage you to use the chat to ask questions or comment and to connect with each other. You can also find a link to today's program there. I'd like to acknowledge our sustaining sponsor and our preferred benefits provider, Michael Craig of Penworth Financial Services. And we could not have produced this event without the support of our generous sponsor, Republic Bank. Now I'd like to welcome CCPA board member and Republic Bank Regional Vice President, Matthew Skilton.
Good morning, everyone. Thank you all for carving out some time in your busy schedules to join us for today's discussion. It's an honor to be here today on behalf of Republic Bank, the sponsor of today's panel, and as a board member of CCPA. At Republic Bank, we pride ourselves on supporting the entrepreneurs who help our local economies thrive through small business lending. Because of that, I'm especially proud to be involved with CCPA in its mission to provide helpful resources to the Philadelphia business community. Today's discussion will focus on the state of residential real estate in Philadelphia and the surrounding suburbs. Each expert on the panel has a unique perspective to bring to this topic. So with that, let's get into it. I'm honored to introduce the moderator to today's panel, Michaelle Bond, residential real estate reporter for the Philadelphia Inquirer. Michaelle joined the Inquirer in 2013 after graduating from Columbia University's Graduate School of Journalism and completing a fellowship at New York Times. She's covered a variety of beats over the last 8 years, but has spent the last year plus chronicling the ways in which the pandemic has impacted the housing market. Her biography and those of the other 4 panelists are in the program, which has been posted in the chat. Please join me in waving a warm welcome to Michaelle, our panelist. Thank you.
Thank you, Matt, and good morning. Like Matt mentioned, my name is Michaelle Bond, and I'm the residential real estate reporter at the Philadelphia Inquirer. And today I'll be your moderator for this panel on housing trends and Philly's future. I've got a great group here today that represents various segments of the industry. So in a minute, I'll ask the panelists to introduce themselves, and then we'll get started. So we'll talk for about 40 minutes or so, and then we'll have 5 or 10 minutes at the end for questions from the audience. So please put any questions you have in the chat during the panel, and we'll pull some out at the end as time permits. So it's been quite a year. Looking back at early last year, the housing market in winter 2020 started off really strong. And then, of course, the pandemic hit, and no one really knew for sure what it would mean for real estate. Then there was the whole wrinkle of in-person real estate being paused for a couple months. People left cities to work remotely. No one really knew what was going to happen. But then we saw that the housing market was a bright spot in a pandemic-battered economy. Demand for homes has stayed high, mortgage rates are still at historic lows, and home values continue to rise. But so too do costs of construction materials. Housing inventory is even tighter now than it was at this time last year, and we continue to be in a strong seller's market. Home construction continues throughout the city on single-family and multifamily buildings. Bans on both foreclosures and evictions are still in place. Some renters are still struggling to pay rent, which puts pressure on landlords and also highlights the need for rental assistance, which is now in its 4th round in the city. Now, as more people get vaccinated and the city's COVID-19 cases drop, the city's finally opening back up, and the amenities that attract residents to the city are returning. So our panelists were here to talk about all this and more. So let's get started. Rachel, if you could please introduce yourself and talk about a project that you're working on that you're excited about. Rachel, you're muted still. Yeah.
All right, sorry about that. Still getting used to this technology. Hi, everyone. My name is Rachel Street. I am the president of Hestia Construction and also head of the Street Group, which is a team of real estate agents at Space & Company. And I'm also the host of the television show Philly Revival on the DIY Network, which follows some of my development projects, rehab projects of older buildings from start to finish. Under my construction company, I do a lot of work with older properties to highlight and restore some of the original features. And we also do a lot of community service work, providing free home repair for those in need, and also working with at-risk teens to help teach them how to start their own business or get involved in the trades, because there's a ton of job availabilities in the trades, and there's a tremendous opportunity to start your own business. I'm a foster mom to 2 teenage boys and a resident of East Passyunk, which is where a lot of my projects are located. And recent projects, I am building a house out in Devon, or restoring a house out in Devon for my mom. So it's a fun project with a difficult client, but and I'm also doing some rental properties in Philadelphia. I've kind of switched. I used to do more properties to sell. Now I'm doing a few rentals, and I'm also doing my first commercial project in South Philadelphia as well.
Thank you, Rachel. Greg, do you want to go next?
Sure. Good morning, everybody, and thanks for having me. I'm Greg Heller. I have a few different hats that I'm wearing, and I'm happy to wear whichever one fits the moment. So I'm the director of the Philadelphia Redevelopment Authority. I'm a senior vice president at Philadelphia Housing Development Corporation, and one of the things that I've been running during the pandemic is the city's emergency rental assistance program, which is processing hundreds of millions of dollars for emergency rent support. And then I'm also the executive director of the Philadelphia Accelerator Fund, which is a new independent lending vehicle to support Black and brown developers and produce affordable housing throughout the city. So happy to talk about all of those facets. Thanks again for having me.
Great, thanks, Greg. Tawan, do you want to go next?
Sure. Good morning, everyone. Tawan Davis here. I lead the Steinbridge group. We develop, right now we probably have a little bit over $2 billion of active developments throughout the United States. Presently, we focus on single family renovation and development Interestingly enough, we got into the business a couple of years before it became the lingua franca of real estate. And so we've been doing it, in fact, for about 4 years in Philadelphia, which is where we started the single family strategy. We own a few hundred single family homes that we've rented in Philadelphia with a focus on workforce housing. So in fact, Greg is probably our biggest business partner right now, even though he doesn't know it. So we try to develop high quality workforce affordable housing in the country. So in Philadelphia, our homes have granite countertops, stainless steel appliances, brand new floors, brand new roofs. So we put probably $60,000 to $80,000 into each house, focused on 4 neighborhoods in Philadelphia: Brewery Town, and a little bit above kind of the 1500 block, which is kind of where people focus on Brewery Town. We're in certain parts of inner West Philadelphia. We're in Point Breeze, and we're in Port Richmond. And we probably own a few hundred in Philadelphia presently, probably have another 50 under active rehab today. So we're very active in rehabbing homes in the transitioning neighborhoods for high quality affordability. And we're doing that from the ground up throughout the United States, where we have about $1.5 billion of ground up development. We have probably a few $100 million of rehab development throughout the United States in the single family space. I'm in California right now, so I'm 3 hours behind you all, so I had to get a wake up call to make this. So if I'm a little slower than everybody else, you'll forgive me. Thank you.
Thanks, Tawan. Phil, would you round us out, please? Phil, you're still there.
Sure, I'm here, Michaelle. Thank you. Good morning, everyone. Thank you for logging on and listening to us this morning. My name is Phil Giordano. I am the Director of Residential Lending for Republic Bank, and I've been in the residential lending industry for about 30, going on 32 years now. So have seen, and most of that time, and still is Philadelphia, so have seen vast changes over the years in my industry, as well as many neighborhoods in the Philadelphia area. 2 projects, well, one project is kind of working itself out, and that was dealing with the storm of residential mortgage loans we had throughout last year, and trying to make everyone happy and get everyone closed and give at the incredible interest rates that were available. And one project I'm working on right now is I've been tasked with the bank's residential lending side to increase our CRA funds that we're making available. And we had actually scored outstanding. The Republic Bank scored outstanding in our last exam for CRA requirements, and we're looking to expand and move further in that. So thanks again.
Yes, great. Thank you so much. All right, well, let's get started. We're exactly on time, which is incredible. So thank you. Hopefully we'll stay on time. So now, all of us have heard the reports during the pandemic of residents fleeing cities and going to more suburban and rural areas. So this question is for Rachel and Phil. How would you compare buyer demand today in the city versus the suburbs? And what are your predictions for the remainder of the year?
You want me to go? I'm happy to. Thanks, Michaelle. So, one of the big contributors was that in March of last year, in Philadelphia, for all intents and purposes, the real estate industry was completely shut down. Almost basically illegal to conduct real estate business from probably, I think it was mid-March until July. And so during that time, interest rates continued to decline, and there was a pent-up demand for real estate. And when things opened back up, the market went crazy and it exploded all over, including Philadelphia. And I mean, in general, what I am seeing is some lack of interest, and Rachel might be better at answering this than me, some lack of interest for center city condos and more interest in overall space, residential, homes. And there's no expectation throughout the remainder of this year that that's going to change.
Yeah, I would agree with that. I think the demand for condos has definitely dwindled, but demand for single family homes has increased. And certain areas of the city that have more of a suburban feel, like Mount Airy comes to mind. I've seen a lot of people wanting to move out to those areas. And with Philadelphia, I think there was a mass exodus, but I think there was also a huge influx of people from other areas. So, during the pandemic, everybody was spending an inordinate amount of time stuck in their homes and started to really reevaluate whether they really liked their homes. And with working from home and homeschooling, a lot of people, I think, realized that they just didn't have enough space. So in Philadelphia, I've seen a lot of people moving out to more suburban like areas of the city or out to the suburbs of Philadelphia or into Jersey. But then I'm also seeing a lot of people coming in from other cities, which are, more expensive. And since they're now able to work remotely at their jobs in DC or New York, they're able to buy in a more affordable city like Philadelphia, which is, I think, contributing to increasing the demand and the prices of homes in Philadelphia.
Yeah, I've definitely heard the same thing about people from New York wanting to move down here, still liking the city feel, but wanting a little more for their money. And Tawan, too, I'm hoping you can weigh in on this as well. And Rachel mentioned kind of the more suburban areas of the city getting some love. In Center City, are you seeing the kind of exodus that places like New York is seeing?
Well, I'd say a couple of things. I think the exodus in New York and some of these, and particularly New York, it didn't seem to happen in other parts of the country. New York is really the only metropolis in the United States. We have a few, Chicago, maybe LA, that kind of feel that way twice a week, but New York is really the only metropolis, and that happened. And it seems to be short-lived there. In fact, there was a flattening in prices there, and they have actually more development activity going on at the markets reopen. And we're active in New York as well. But what we found in Philadelphia is that the national trend of single family demand is at an all-time high for a couple of reasons. One is that there is a dearth of supply in the market. And that is a long-term dislocation between housing supply and housing demand that has been around since the 2008-2010 financial crisis. Second is what Phil was talking about, is the fact that for 3 months, really maybe 4.5, because it took about a month and a half to restart construction activity after the pandemic came, because people were trying to figure out, PPE requirements and all of that kind of stuff. And so it took about 4.5 months of really 3 months of no productivity and maybe 2 months of slow productivity as regards to construction. And so that slowed construction in Philadelphia. And so that's the second reason why there's continues to be demand in and around Philadelphia. The third thing is is the preference now, I think, as Phil was saying, for social distance housing. And Philadelphia is lucky because roughly 700,000, I think, of the 1 million and change housing units in Philadelphia are row homes. It's like 700,000 has the biggest row home supply in the United States. So it's kind of like you can have the best of both worlds. You can live in a quasi, close-knit situation, quasi-multifamily situation, but have your own walls, your own bathroom, your own, no shared space and all that. So in our situation, we probably produce, I would say we probably on a good week, month produce 10 to 15 units a month. We pre-lease probably 12 of those, and we get 500 inquiries a month for our rental units. We track them, and that is when we only have maybe 3 or 4 available. And we get 500 inquiries a month. If we have more than that, we probably get 800-900 inquiries a month for those houses. And so we're pre-leasing them, and the ones we're not pre-leasing them are leased within a week or two. So there is both on the rentals, and because we do high quality, we actually get a long list of people. So both on the buy side and on the rental demand side, there is a huge preference presently nationally and in Philadelphia for single family living. And so I think that's a long-term trend.
Makes a lot of sense. And going off of what you said about inventory, I do want to, ask about that and throw this question open to any of our panelists. But as everyone knows, home inventory is at an all-time low right now. Are you expecting us to see an increase in available properties over the next few months? Do you think it'll stay a seller's market for a while to come? What are your thoughts on inventory right now?
I think it's going to stay a seller's market for a while. And the main reason is right now, I think the demand will slow a little bit as businesses start opening back up and people go back to work physically. But I don't think there's going to be an increase in available properties right away because construction costs are so high. So where a lot of developers got hit during the pandemic was, you come up with your budgets ahead of time, you submit them for financing, and lumber prices have increased like 171%. I was saying earlier before we got on the call, I bought OSB for $73 a sheet the other day, which is wild. And so it makes a lot of projects unfeasible. And, I think there are a lot of builders that I know that are just sort of waiting for the prices and the supply chain to sort of stabilize before they continue to build any, large scale projects. I know personally, I'm kind of not doing as many full rehabs right now in favor of smaller, sort of more cosmetic projects. Because aside from the prices, there's also a huge delay in obtaining materials. So certain things are back ordered, appliances, windows, doors, those are all taking a lot of time to come in. And so with shortages across the board, I think that the housing inventory will continue to be suppressed until those supply chains are kind of open back up again.
Yeah, I think Rachel makes all good points. We're experiencing each and every one of those things. The increase in lumber has become a congressional matter. I mean, they're trying to figure out how to bring the price down. It's pretty dramatic. I would also add the one thing, we all think we're smart until interest rates increase 50 basis points.
That's what I was going to say.
Well, they were really good at this.
Oh, interest rates stay really down. Everything is beautiful.
I'm going to be a billionaire. Shucks. Then interest rates go up 50% and all bets are off. So I think it's so easy in the real estate industry to underestimate the impact of macroeconomics. And we're highly dependent on that. And two things are favorable is the low interest rate, both for developers and borrowers on the supply side and on the demand side. And I think that's sustainable for a period, but there are certain inflationary pressures in the economy, and Phil would know more about that. But there are certain inflationary pressures that may change or moderate the Fed's view of inflation. And I think that's the one thing that might have a counteract pressure on the demand side for housing.
Right, Tawan. And so just on that subject as well, so we did see about 3/8 to 0.5% increase in interest rates in and around March, which does not seem to have had much impact on the sales market. It impacted our refinance transactions somewhat, but on the sales, it does not seem to have had much impact. And the Fed is also saying now that there's no expectation or anticipation of any change in interest rates, with the exception of normal economic factors that could, affect the T-bill on a daily basis.
Cool.
Now's the time to refinance into long-term loans and lock in those interest rates. That's what I'm doing, at least.
Well, Phil, if you could look into your crystal ball here, given that information from the Fed, what do you think we'll see, interest rates do in the next half of this year and maybe even into 2022?
So what Freddie Mac is saying is that basically there's going to be a slight rise throughout the remainder of this year, but nothing dramatic. And, they're in and around the 3% range right now. So that's, interest rates are a matter of perspective, because if you speak to a younger borrower who's not in my generation, I'll be nice to myself, and they hear 3%, they may think that's a little high. But if you speak to someone in my generation who may have paid 8, 9, or 10%, 3% is a windfall. So it's also a matter of perspective. But overall, I think we all can agree that a 3% interest rate is favorable for purchasing. And that's probably part of what's driving the market right now, in a little bit, other than the other items that we mentioned. Again, that's what the quote experts are saying. And so, but understand that the interest rates, the long-term mortgage interest rates are tied to the treasury bonds. And what affects the treasury bonds is a multitude of economic data, or, which is potentially shows that the economy is getting better or the economy is getting worse. Could be your consumer price index, could be your consumer confidence index, could be new housing starts, could be existing housing starts, unemployment, new jobs. So there's a lot of things in the short term that could affect an interest rate. But typically, when the Fed does something, that has the biggest impact on our interest rates. And with the anticipation of that not happening, as we talked this morning, I don't see any real major changes coming this year.
Okay, I won't hold you to that, but we'll see what happens.
Please don't, because people ask me all the time, well, what are interest rates going to do? And I say, if I knew that, I would not be talking to you right now. I'd be on an island somewhere.
Exactly. But I appreciate your insight. But Tawan, this next question is for you. And this is kind of looking back a little bit and then kind of also looking ahead. In April 2020, Steinbridge announced plans to expand its Philadelphia footprint. So can you tell us more about what prompted that announcement and how the ongoing pandemic has impacted those efforts? And then also what's next in terms of your investment in our market?
Sure. Well, listen, we're very bullish on Philadelphia over the long term. Philadelphia is less reactionary to economic cycles than other parts of the country. When the rest of the country corrected by 30 to 35% in the 2008 financial crisis, the real estate price correction in Philly was maybe 15 to 20%, and that 10 to 15% difference makes a world of difference in underwriting and investment. So we're very bullish on Philadelphia in the long term. We have every intention of continuing to expand our work in Philadelphia because the supply and demand dynamics, both on the rental and the acquisition, home acquisition side, remain strong. When we announced in April 2020, in the middle of the pandemic, that we extended is because we wanted to really demonstrate our continued commitment to the city and to the neighborhoods in which we invest, and our long-term commitment to workforce housing. What we did have to do was shore up our construction given the delays. So we've spent much of 2020 finishing projects, the latter part of 2020 finishing projects, and making sure that we were able to deliver the same quality and adjusting, frankly, some of our price mechanisms because of all the stuff that Rachel talked about, internalizing some of our construction work that we had third-partied before. But in 2020, the latter part of 2020, we really want to continue to acquire. And I think that really is two things. Number one is acquiring single-family homes for renovation. And second, what we have done around the United States and we're not yet quite in Philadelphia, it's really partnering with property holders for major rehab or major redevelopment. So what we find is we have this philosophy around activating latent assets focused on large landowners. So with, for example, with a couple of the historically Black colleges and universities throughout the United States, we are rehabbing and redeveloping probably altogether maybe 300-400 acres of land that are centered in and around major cities, but have been underutilized. We're also doing that with major churches, nonprofit institutions that sit in the middle of Dallas or in the middle of Washington, D.C., own acres of land that they've owned for maybe 50, 100 years that they haven't revitalized. And so we're looking to do similar work in Philadelphia, partnering with institutions to revitalize their centrally located real estate. So those are our two kind of major strategic approaches to our Philadelphia work.
Speaking of, rehabbing and revitalization, part of what makes Philadelphia Philadelphia is its history. And Philadelphia is home to hundreds of historic buildings. So Rachel, I was hoping you could talk a bit about if you think that we'll see an increase in the state's historic preservation tax credit annual cap.
I mean, I would like to. Ours is really embarrassingly low. Philadelphia, so for people that don't know what that is, the state basically provides a tax credit, to qualified taxpayers who are completing a restoration of a historic structure. And it has to be approved by the commission. And there's a cap of, I think it's a $500,000 per taxpayer. And then I think there's a total cap for the state of 5 million. Other states are like 5 million per project. So, and don't have a cap. Like I think New York doesn't have a cap. So, Philadelphia, it's kind of ironic because we are one of the cities that has such a wealth of historic buildings and such important history here too. And we seemingly do the least to protect it. But I think in recent years, there's been a much, more of a call to preserve our structures. There are coalitions that are now, kind of forming to fight the demolition of important buildings in the city, although they haven't been overwhelmingly successful, unfortunately. And so I do think that there's going to be increased call for it. However, I think with all of the other things that are going on right now and, all of the budget that's going toward helping businesses in the pandemic and sorting out all sorts of things related to COVID-19, I kind of think it's going to continue to kind of sit on the back burner. I know they had tried to increase it dramatically, I think in 2019, and it increased a bit, but not a lot. So I kind of think it's going to take a bit longer, but I hope that it will get more attention.
Kind of segueing from that into, the older housing stock that Philadelphia has. And I know, part of keeping people in their homes is doing rehabs and things like that, and making sure that they stay habitable and, that they're safe, that people can stay there. In terms of, making people who may be renters or who may be coming to the city and are living, intergenerationally with family or friends. Greg, this question's for you. So how do we, as a city, collectively make home ownership more accessible for all?
So it's a great question. And I think that it's important to start out by saying that we do need to make home ownership more accessible for all. The disparity between white and black homeowners, not just in Philadelphia, but in every city and across the country, is just unacceptable and is at a level that really is a national crisis that we need to be focusing on and working to reverse. So it is really important, but I think it's also really important to focus on the idea that home ownership isn't necessarily the best route for everybody, and that we need to also really bolster the affordability of our rental market. And I think it's also important to remember that home ownership is a way of building equity, but it's not the only way of building equity. It's not the only asset class. It's not the only way of building neighborhood wealth. And it's also, especially not the only way to build wealth for communities and people of color. So I think that it's important to focus on home ownership within the larger context that more broadly, we need to focus on accessibility and affordability for everybody, whether you're a renter or a homeowner. And we need to focus on a range of strategies for building community wealth for communities of color that includes homeownership, but is not restricted to homeownership. So that all as background and context, there are a couple of things. One is that there's been a lot of attention nationally, and there has been some work done by city council and groups like the Reinvestment Fund that look at the fact that the appraisal industry has a certain degree of discrimination and racism in its practices. There have been a number of studies that have now shown pretty conclusively that when you take a sample of homes and you have a white person in the home when the appraisal is happening, and you take the same home and have a different appraisal and have a black person in the home, that they appraise significantly differently. So there is racism and discrimination happening in the appraisal industry. Like I said, this has been proven out by studies by the Reinvestment Fund and others, and there are groups across the country and in Philadelphia looking at how to address and reverse this. So this shouldn't be a surprise to anybody. But if you want to talk about accessibility of home ownership, we have to deal with racism within the appraisal industry. Two is that down payment and closing costs are a big barrier for a lot of families. Cities and states all over the country have down payment and closing cost programs. Philadelphia has one that is out of money right now called Philly First Home. But City Council recently introduced a $400 million housing bond that would put more money into Philly First Home. Just to step back for a second, the idea of a housing bond is really critical. The Biden administration has been publicizing the idea that housing is infrastructure. Within the industry, we've known this for decades, that housing is essential infrastructure, just like roads and bridges and rail. And if we accept that it's infrastructure, we need to finance it like infrastructure. And the way that we finance infrastructure is with bonds. So we really should, I want to give huge credit to City Council for moving forward what's called the Neighborhood Preservation Initiative, which is this $400 million bond that's going to invest in housing and neighborhoods. And this is something that we really should be doing as a city on a regular basis, just like on a regular basis, you know, you go to the ballot and you have an additional, item to take out debt for roads and bridges and water infrastructure. We need to do that for housing as well. So it's important that we find ways to continue to finance programs like Philly First Home. I do want to also point out, though, that the reason why cities and states need to create down payment and closing cost programs has to do in part with the fact that FHA mortgages require a certain percentage of down payment on behalf of the borrower, and also issues with private mortgage insurance. So I actually think that there are regulatory issues that could be done at FHA that would remove the need for cities and states to actually subsidize down payment and closing costs that are being required by the federal government in the first place. So I actually think that there's a larger policy issue at play that could save cities and states millions of dollars that are going into making housing accessible. So those are a couple of things. And then the third thing is just that we need to increase supply. The issue that's essentially the redlining of our day is exclusionary zoning. This is something that also the Biden administration has specifically called out, that's been written about in op-eds in the New York Times. So again, this shouldn't be a surprise to anybody. But the idea that we have areas that are restricted to just single family housing we need to rethink that in a really critical way. And we need to allow for more diversity of housing types. Michaelle, you were talking about multi-generational living. There are a diversity of housing types that people want in the marketplace. They want to live intergenerationally. They want to have in-law apartments. They want to be able to monetize ADUs and basement apartments. There are a variety of housing types that people are looking for. They want to have co-living. So all of these things require more flexibility in terms of our zoning. And we need to make sure that we're providing that flexibility so that we can build the product that the market is looking for. And we can make sure that there's enough supply to provide housing for all. And then the last thing I'll just say is that it's really important that we make sure that housing truly is affordable to all. So Philadelphia has a really profound housing crisis. Before the pandemic, 50% of renters in Philadelphia could not afford their rent. If you take the top 25 professions that employ people in Philadelphia, 18 of them do not pay enough for a single individual to afford a one-bedroom apartment in Philadelphia. That represents over 80% of Philadelphia's workforce cannot afford a one-bedroom apartment. That is a crisis. We need to deal with it like a crisis, and we need to take really bold steps to make sure that people can afford their housing, because right now, Philadelphians just can't afford their housing. They don't make enough. They can't afford it. We have a big problem.
I think a related issue to that, if I may, is also not just getting people into homes or home ownership, but also being able to afford to maintain their homes. So like, I think, you know, as a realtor, we go into a crazy amount of homes, you know, every year. And so much of our housing stock is in such a state of disrepair. And so people are being forced to sell their homes because they can't afford to maintain them. So if you're not able to afford to pay rent for a one-bedroom apartment, let's say you somehow made it into a home or inherited a home, you still have to pay the real estate taxes, obviously, but you also have to be able to maintain it. And some of the projects that we'll go into to do some home repair, it's like a small roof leak that maybe you could fix with $800, $900 has created a $30,000 problem because it was, you know, not able to be fixed in time. So I think another important aspect is, you know, and Philadelphia has kind of started doing this, is providing, you know, low interest loans to people to refinance, not refinance, to renovate their homes and fix some of those issues, and programs to help them out in those situations. Because I see a lot of that of people that really can't afford to maintain their homes and then they're forced to move.
You know,
Rachel, if I could just piggyback on that, because my agency actually runs that program.
Yeah, I've moved.
So you're 100% right. The most affordable home is often the one that people already live in. And the Philadelphia Fed did a report showing that there's a huge need for people to make home repairs and renovations. The Fed also did a report in 2018 that showed that within the commercial banking industry, based on HMDA data, that for Philadelphia low and moderate income borrowers who are seeking home repair loans, there is a 75% denial rate. So that means that Philadelphians are seeking funds to repair their homes, to make them safe and healthy and habitable, and are getting denied by banks. So we took the initiative on that, and we created a program called Restore, Repair, Renew, which provides home repair loans at a fixed 3%, 10 years. And we make it available to people with a 580 credit score or above. And we've seen incredible results. The program's been up for a little over 2 years now, and we have a 58% approval rate, and over 80% of our borrowers are people of color. Also, we've had 0 defaults, and we have a 3% delinquency rate, which actually outperforms the HMDA loans. So we have less restrictive underwriting, and we have better performing loans that are actually going, and also the average income is about 60% of area median income. So it's going to low, moderate income people of color who are otherwise not being able to access loans. So we think that we need more of this, and we do this by partnering with private banks who originate the loans and then sell them to us after the construction is done and it turns into a term loan. We're happy to buy them because, like I said, there have been 0 defaults and we have low delinquency. And so we think that this program really works for everybody. We also have a program called the Basic System Repair Program, which is also being replenished by the Housing Bond. This is a grant program for very low income homeowners who need essential property repairs. We do thousands of these a year. And what's interesting about this is that not only is it beneficial for the homeowner, but we believe that there are really substantial effects on the neighborhood at large. There's been some preliminary evaluation of the program that's actually linked it to decreases in gun violence, for example. So we think that there are a lot of reasons to make sure that we're investing in people being able to maintain their properties. And of course, I think you've read all about the health and housing issues. One of the major, causes for emergency room visits for youth has to do with home-based health triggers that cause asthma. So all that to say, yes, we definitely need to find every possible way to allow low moderate income homeowners to be able to invest in maintaining their properties.
And it's not only just the financing, but also policies regarding like rehab of homes. Like one thing that comes to mind that Philadelphia did to address a different crisis, a lot of people were illegally underpinning their buildings. And so a lot of buildings were collapsing because they were, digging out the foundations and it wasn't supervised. And they were doing under what's called an easy permit, which was an over-the-counter cosmetic permit. So they were doing something that was illegal, but instead of having more oversight of the existing easy permits, the city kind of did away with easy permits for the most part. And so now in order to renovate a property, you have to get plans drawn up, which is, more expensive. It's going to cost you a couple $1,000s more to get those drawn up. And, in order to go through the whole approval process, which takes more time. And so it for people who are either smaller companies or, people that are trying to renovate their properties and make them better, it's becoming more costly and time consuming to do so. So some of those smaller landlords that might want to pull a permit and renovate their property, to provide a safer place for a tenant, it's several $1,000s more than it was just a couple years ago because of these new regulations, when perhaps it could have been better to be addressed by kind of more oversight of whether people are doing work that's conforming to the permits that they pulled.
I'd say three things. First of all, on the appraisal issue, Greg, I read New York Times had a great article last week about this exact issue. And we circulated around the company because I was a little shocked because it was consistent with our experience in Philadelphia. There's one street where we own probably 8 houses, I'd say 5, maybe 8 houses in Port Richmond. And we had done a good renovation job. And at the end of the renovation, we get an appraisal of 225, 223, 220, 129. What happened here? 117. Shit, it's the same house. And what we noticed was 2 things, which was shocking. And I didn't pay attention to this until after I read the article. Not only was it who the homes, but it had to do with which property manager we sent out to meet the appraiser. Dude, that shocked me. And I didn't realize that. So we have experienced that and actually didn't know that it was going on. It's a very real problem. Second thing, though, I would say is I'm not sure that I agree on the question of home ownership, because listen, if everybody in the United States rented a house, it'd be great for our business. That's what we do for a living. And so if we were more like France or where there was a predominance of rentership, that'd be great. So we don't want anybody to own a house. On the other hand, there is no better way to build wealth. And so for African-American people, it is essential. The fact is that I can't think, and I'd be interested to hear Greg's thoughts on what are the other ways. Particularly, the African-American middle class was built in the 1950s and 60s because of the 2 main employers in the United States were the government and the auto industry, both of whom had fixed pension systems. And now that just doesn't exist anymore. There is no such thing as a fixed pension. And so the African-American middle class, particularly in Philadelphia, has basically disappeared. And so now that you have a city in which an average worker makes $36,000 a year, which doesn't put you on the first rung of homeownership. If that, and that's for a family, not just an individual. And so, there are no pensions. If you are making $36,000, you're not putting anything in a 401k or enough. Even if the average American family makes between $50,000 to $57,000 a year, depending on who you believe. And that still only puts you on the first rung of the homeownership ladder for certain parts of the country. And so I don't think there are, in fact, available to most Americans, meaningful wealth building. When I mean wealth, I mean that allows you to retire comfortably by 65. Doesn't make you rich, doesn't make you Warren Buffett, but it allows you to retire comfortably by 65. That doesn't exist today in the way it did for the baby boomer generation and their predecessors. And so I actually think that homeownership is probably one of the only ways for people of color to begin to get on the first. And again, I'd love for everybody to rent. It's great for our business, but I don't think it's actually good for minority communities to be long-term sustained renters. The intergenerational wealth created by homeownership is essential to long-term family building. And I don't think that stock buying or in bond investing or pensions really are available in any meaningful way to the vast majority of American middle-income workers today as they were before. The third thing I would say is that it's so important for us to be partners with government, but not dependent on government. That the private capital, and this is what we don't actually take government funds. We don't do LIHTC. We don't do new market tax credits for the most part. I have a philosophy around the idea that private capital has both a responsibility and an opportunity to invest in these communities, and that the returns are better for one. I mean, if you look at the Canyon Johnson founded back in the 1990s, investing in these transitional communities had better returns than anybody in the real estate market for 20-some years. The returns are better, but also the capacity to control the outcome and to create a most impactful outcome is better. And it gives you more flexibility as an investor, as a developer, as a real estate owner. And so we actually believe that, you know, all of the government programs are helpful, but that it is that the government, there is not the political will nor the tax base available to provide the housing needed for working Americans. And so the private capital, private investment, private developers, private real estate is really going to be the key to turning this around. Over government dependence is actually going to be problematic because there's never the sustained political will to make that impact on, and there's never enough taxes. But what government can do is partner, as Rachel was saying, with investors, with developers, with capital providers, try to get rid of some of the red tape, try to get rid of some of the fee burden, try to get rid of some of the regulatory burden, and allow people to move forward and provide high quality opportunities, and then temper some of the controls they have. I mean, even if you think about the ongoing rental assistance, not the rental assistance, the moratoriums. I mean, shucks, man, I take a deep breath every time the moratorium is extended. I have to, it's a real threat. Let's be clear here. It's a real threat. If people say to themselves, you know what, I'm just going to take this month off. And if they do, we got 9 months before we can do anything about it. That can be a real threat to our business. So I take a deep breath and say, you know, overall, it's a big problem. So there are certain things that I think the government has to do to encourage private investment, to encourage private activity and not stand in front of it. I think it's very important. So those are my 3 thoughts.
Yeah, Tawan, if I could just piggyback off of that, I totally agree with your assessment of the role of government. And that's basically what we've been trying to do over the last 5 years, is find sort of the lowest touch that government can provide in order to move the private sector, right? So I gave the example of home repair loans. If there weren't a 75% denial rate, if there were already over a 50% approval rate, we wouldn't have needed to do anything as government. But we saw that there was something broken within the private sector system of providing capital to low, moderate income homeowners. And we said, what can government do that's the lightest touch in order to move this forward? And we actually worked very closely with a number of banks to try and figure out what that was. Unfortunately, it was a little heavier touch than I had initially hoped it would have to be. Initially, I was hoping we could just guarantee loans based on a certain set of underwriting criteria, and nobody wanted to do that. So we ended up having to buy the paper ourselves. But we still have private banks originating. And our hope is that over time, once we show the performance of this portfolio, that private banks will just start making loans of these characteristics to these borrowers on their own without us, because, you know, the loans are performing. right? So that's our hope, is to show proof of concept over time and to nudge the private sector to do this without government. Another example is on the workforce housing side. We're having developers coming to us saying, we want to build workforce housing, but our typical lenders aren't giving us good terms on this, and we have to put in too much cash equity, and the whole deal doesn't make sense because these are, income restricted units. And so I said, let me talk to your lenders. So I talked to about 5 different lenders who these developers threw my way. And I said, what if we guaranteed 25% of your construction loan, but you had to provide financing at least 85% loan to cost? And they said, yeah, that would do it. So we worked out that 25% was the right amount, and we ended up putting out our workforce housing credit enhancement, which is now built or been, partially responsible for building hundreds of units of workforce housing. Lenders love it. We actually charge 150 basis points on this, so we love it too because there have been 0 defaults. So we get paid for a piece of paper. Developers like it because they don't have to put in more cash equity than they can afford, and it builds the units. And we actually won the Urban Land Institute's National Best Affordable Housing Program of the Year award 2 years ago for this. So I think it's a very light touch from government. Everybody likes it. And we think that's the type of thing that government needs to do, is come in, talk to developers and lenders and figure out what's the right role for us to play in order to move all of the private sector parties to the outcome that we want to see, show proof of concept, and ultimately be able to step away, hopefully, at some point.
No, that's a great, we get those terms, but probably not your interest rate. So we should talk, because maybe we want your 25%. The 580 credit score, there's not going to be a bunch of banks that are going to chase a 580 credit score for a homeowner. So I think part of this is also, what you're providing is very important. Part of this is also financial literacy. I mean, it's funny, I'm very interested in why I wrote my graduate thesis on why African-American people are poor. And I'm very interested in this idea so I read every single credit report we get. I mean, small stuff. I mean, Verizon wireless payments that people miss for $90 are knocking their credit score from 700 to 580. I mean, it's pretty dramatic, because the stuff that you think are, I mean, people have, education credit and stuff like that everybody else has, but it's this, I mean, for people's credit is being destroyed over, from what I can see, for $1,000 or less. I mean, being decimated, simple stuff. So I think that one of the major things that we could do is really help with financial literacy. Someone put up a question, and I'd be interested, Greg, as well. What are some of the other ways, and I saw it bounce up on the screen, what are some of the ways that, we can encourage wealth building outside of homeownership? Because, I think about it particularly if people are making $50,000 or less. I mean, what do they do if they can't buy a house? I'm not smart enough to come up with meaningful, sustainable ideas around it, because every dime seems to slip through your fingers at that point. You can tell them to save, but it's not realistic. The marginal propensity to save at $50,000 or less is less than 3%. So, what can people do to create wealth? And this goes to then the housing market and housing demand, because the more people own, the more people are able to create wealth, the more housing demand. So I'm just kind of interested in that. I think I saw 2 questions along those lines bounce up on the screen as well.
Yeah, so just to talk about credit score real quick. So there's a good body of research that came out of the Kansas City Federal Reserve that actually shows that credit score, when you adjust for certain factors, is not a statistically significant indicator of risk. Mm. So they did this based on first home mortgages, not on home repair loans specifically. But when they did this and you adjust out for debt to income and a couple of other factors, they found that credit score actually has no correlation to risk. And so we're also hoping to use this as a way of sort of getting the word out about this, that we need to evaluate risk for sure. You don't want to make loans to people who can't afford them, right? That was the whole issue back in 2008. But we need to be actually evaluating risk and not using artificial algorithms that, reputable studies have shown aren't actually correlated to risk. So in our home repair program, we do actually require a 43% DTI, which I think most banks would agree is a fairly, standard underwriting criteria, but we allow for a 580 credit score. And, again, like I said a few times, we've had 0 defaults and we have a low delinquency rate. So we actually think that using DTI and not even looking at credit score at all could be a reasonable way of start moving towards mitigating risk while also not discriminating against people who credit score typically discriminates against, which, as you said and has been well documented, one of those groups are people of color. So we do think it's important to think critically about what actually is correlated to risk and what's been shown to not correlate it to risk. In terms of the wealth building question, I mean, you're right that right now in our current society, in our current ecosystem, there's probably no better way to build wealth than home ownership. And, like I started out saying, there is a huge disparity between white and black home ownership, and that's a real problem for our society, and we need to overcome that, and we need to provide every opportunity for building black home ownership in America. But do I think that it's the right thing that home ownership is the best and only way to build wealth? No, I don't. And there have been a number of folks out there who are talking about alternative ways of building wealth. But those don't exist as large scale, really accessible avenues right now. But I mean, you look at the reason why home ownership is such a good deal. I mean, you can get an FHA guaranteed mortgage, at 3% or even less. I don't know exactly what it's out right now, but I've been seeing people getting under 3%, 30-year fixed rate guaranteed. Well, think about if you could get those same terms to purchase other assets, right? Federally guaranteed 30-year under 3%, to buy other, publicly or privately traded assets. You just can't, right? So, I mean, I think that's part of the problem is that we've provided a government-backed product to purchase one specific asset class. So I think that that's something we can look critically at. And there are folks
that will never disappear because, as you say, it is America's pension system. And this is why in the 2016 election, there was all this discussion about getting rid of Freddie. That's never going to happen. It's because it actually is America's pension system. And that is why, again, it is so important, why home ownership in these minority communities is so important, because you have people that then arrive at 63, 65 and a half, whenever you can retire, 66 and a half, with a zero pension because they haven't bought a house. And so you look at government dependency and you look at kind of under, poverty among senior people of color, and it's higher because they just haven't bought a home. So I think it's essential. It's unfortunate that it's essential, but given the current context of the American economy, I do think home ownership is probably the most important.
I totally agree with you. I would like to see new avenues for community wealth building at scale. And right now there are some experiments happening that aren't at scale, that are very small scale. But when you have people living in a neighborhood and you have development going on in a neighborhood, there needs to be a way for people to invest in and appreciate the upside of that new development and of the appreciation of their neighborhood, independent from the value of their individual home.
One of the things we're doing is working on setting up a REIT to do exactly that. So, all of our homes are collectively owned. We are, they're cash flowing positive. We end up owning thousands of them. So maybe you can't own the house that you live in, but maybe you end up owning a REIT that is connected to that house. And so I agree with
Great example.
The other thing too, I think is that's a huge barrier, is just financial education. I mean, I go into a lot of schools and talk to kids about starting their own business and how to build wealth specifically through the trades and real estate. And, I think that sometimes it's assumed that these children have, or, young adults have had somebody telling them what the game plan is and the roadmap to becoming wealthy or to owning a home. And in most cases, and even surprisingly in neighborhoods that you wouldn't expect, kids really don't have a good sense of what credit is, how loans work, what an amortization schedule is. And so they don't really even know where to start. And so as they become adults, they're kind of pushed into hourly jobs because nobody's really shown them how to invest. So I think the biggest barrier is getting your foot in the door, and there are definitely certain communities that have had a historical barrier to entering into real estate. But I think a huge thing too, to help people be able to afford homes and investment in real estate is teaching them, how it works and financial literacy in general.
That is a great note. We are at time, unfortunately, a little over time. I apologize we weren't able to get to all the questions, but hopefully you can stay after a bit, Jessica, and get your answers. Was hoping we would just go kind of round robin style a little bit and just close with a final thought from each of you, Greg, Phil, and Rachel, just kind of looking ahead and any kind of closing remarks you'd like to make.
So I can start. If I can just give some advice, touching on what we discussed this morning, there are a multitude of programs for home buyers, particularly first-time home buyers. And Greg had mentioned something earlier about the Philly First program, which was really a great program that we utilized a lot of last year. But the Pennsylvania Housing Finance Agency, PHFA, as it's known, just started a program in March called the K-FIT, which is basically, Greg, no offense, probably better than the Philly First program in that if you meet the income requirements, which are more liberal than the Philly First program, I believe in Philadelphia, you can be up to $115,000 in income. They'll lend you up to 5% of the sale price in a soft second mortgage that is forgiven after 10 years. So if you couple that with a low down payment FHA mortgage with 3.5% down, or they'll even do it for a veteran at 0 down, it really can spark home ownership for people who, because someone mentioned it earlier, I'm not sure if it was you, Greg, or Tawan. What we see oftentimes is the borrower or the consumer is comfortable or able, per our guidelines, to make the required monthly payments, but the upfront out-of-pocket costs really hinder them from getting from point A to point B. And so this is huge. And we also, the First Front Door program is a program that's administered through the Federal Home Loan Bank of Pittsburgh, I believe. And the K-FIT, the PHFA K-FIT is just a really solid program that they've come out with. And so far it's working really well.
Yeah, I think it's important, as a final note, just to put it in perspective that, if we look at things over a historical period of time and interest rates and what happens with the real estate market, eventually all of this is going to stabilize. And my advice is to, when the pandemic hit, people were freaking out and wanted to make all sorts of moves. But, I think we've seen over time things flux up and down, and Philadelphia is a really great place to still be, because we're one of the most affordable big cities on the East Coast, and we still have room for growth. So, and here in Philadelphia, like as somebody mentioned earlier, the prices during the economic downturn of 2008, 2009, yes, prices went down in Philadelphia, but we weren't hit as hard as other areas. And so I think it's important to just kind of put everything in perspective. Things will eventually normalize again. And right now, for first-time home buyers, my advice would be to, to partner with people real estate agents who really understand valuation, understand how things work, good lenders. A lot of the local lenders here in the area, as opposed to those online, fill out a form type things. But lenders that can look at things critically and isn't just checking a box. They can, look at the situation and really evaluate it and help you better than kind of an unknown face out in cyberspace. So as long as you have the right people on your team, I think Philadelphia is still a great place to invest in, but not to be over emotional with these crazy prices and overpay for something just because you want to get in.
Greg, final thoughts?
Sure. I agree with Phil that it's great that PHFA is offering a first-time home buyer program, and overall the KFIT program is good, although I will note that it has a credit score requirement that is much higher than our Restore, Repair, Renew program. So that's going to shut out a lot of people, unfortunately. And I agree with Rachel that Philadelphia, when you compare absolute housing prices to other markets, is very affordable. But when you take our housing prices as a function of incomes, Philadelphia is actually one of the least affordable markets in the entire country. And as I said before, 18 of the top 25 professions that employ people in Philadelphia don't pay enough to afford a one-bedroom apartment. So I do think that we need to, and the mayor and city council have been focusing a lot on anti-poverty efforts. But I mean, we really need things like ongoing rent assistance, ongoing home buyer programs. We need a guaranteed income program. We really need to find ways to boost household incomes and wages in Philadelphia so that people can actually afford housing, because 50% of people in Philadelphia can't afford their housing, and 26%, that's 1 in 4 people in Philadelphia, live in poverty. So for a household of 4, that's $26,000 or less a year. 1 in 4 people in Philadelphia, that's what they make. So, I think we have some really significant issues here, and we need to focus both on the wage side as well as the absolute housing affordability side.
Wait, Tawan, we're just doing last thoughts with everybody. If you want to share any final thoughts.
Sure, thank you. I lost connection for a second there, and sorry, it took me a minute to get back on. I'd say 2 things. First, we actually keep a relatively high mid-600s average credit score, even though I agree with you, Greg, that it's not a great indicator. We do that because our banks want it. So by the time we go to put these things into mortgages, they want to see that our average credit score is relatively strong, despite the fact that we are providing kind of working family workforce housing. They feel more comfortable with that score. And so we try to skew in that direction for that reason, so that we can report back to them. I mean, we track everything from income to background to age and all that, and credit scores are kind of one of the most important things that they want once we try to stabilize these assets in a grouped mortgage. Here's what I would say about Philadelphia. I think that Philadelphia's, and I say this probably in every panel or every talk I give about Philadelphia, and that is Philadelphia's biggest threat is its social contract. It's the social contract. I think of the social contract in each municipality as including 3 things: education, safety, cleanliness. And I think that what Philadelphia has to figure out, that maybe other cities that have wanted to grow have figured out, like Washington, D.C., is how do you create a strong enough social compact to sustain the desire for people to live in your city. And I think that Philadelphia, the fact that we can't rebuild a strong middle class, given all of the statistics. I live in Philly right now, so I'm living this on a day-to-day basis. I live in by the Italian market. And the challenge, I think, for Philadelphia is that it has one of the toughest school systems in the country. Let's be clear. It has one of the toughest policing problems of any major city in the country. And it's not the cleanest big city in the country. So if you take those 3 things and you talk about rebuilding housing prices, stabilizing housing prices, creating economic growth, having companies come to the city to create that middle class, I think that's the challenge that the city faces, really, is its social contract. And that we forget is the first mover in real estate valuation and in economic growth. I was around, in fact, I was the EDC, or I was one of the number 2 guy at the EDC, which is the New York's version of the PDC, and in the Bloomberg administration, and right after Giuliani. And one of the things that Giuliani did was he basically focused on cleanliness and safety in Harlem. And our investments in Harlem, I invested and led our church's investments in Harlem. We bought a bunch of houses for $100,000 to $120,000, renovated them for $100,000. Each of those homes is worth $3 million today. And that was 1991 to about 2003. That boost in Harlem, the first mover was not the real estate guys. The first mover wasn't the capital. It was the fact that they made it safe, and the fact that they made it clean, and they improved the schools. And one of the things they did was charter schools. There's a whole argument about whether that works or not, but they focused on the social contract, and that social contract basically led to a historic boom in Harlem, also in Brooklyn, in certain parts of Queens, and that happened in Washington, D.C. as well. So I think that for me, the risk to Philadelphia isn't the economy, it isn't interest rates, it's those three things. And I think those continue to threaten the city's growth and the attraction of companies to the city and the attraction of a strong middle and upper middle class to sustain the city's growth. And so that's kind of my prayer for Philly, is that really it tries to really focus on figuring those things out, or else we will continue to be kind of the second fiddle to some of these other powerful cities on the Eastern Seaboard. Boston's another city who kind of figured it out. I mean, Boston has Dorchester, which used to be crime-ridden, is one of the most beautiful neighborhoods in Philadelphia and Boston today. So other major cities have figured out how to address these three things in a way to sustain long-term growth. Philadelphia has not figured it out.
Hey everyone, thank you very much for your thoughts today. Thanks for joining us on this panel. Everyone in the audience, Ben, I'll throw it back to you.
Okay, thank you. That was a very good conversation, a lot of insight. Hopefully we'll make some changes.